Good evening, everyone. Thank you for joining us for this evening's Endowus webinar titled "Is the U.S. Economy Headed for a Tough Recession?" My name is Sean, Head of Investments at Endowus. When we decided on the topic a few weeks ago, discussions were centered squarely around the topic of slowing growth and high inflation, or rhetoric around a stagflationary environment. This has since pivoted to the idea that the U.S. economy might be headed for a hard landing or a recession, post comments shared by Fed Chair Powell overnight yesterday. I'm joined this evening by two seasoned portfolio managers from the top of the world's top asset management firms, Hani Reda from PineBridge Investments and Dr. Emmanuel Sharif from PIMCO, who will be providing their comments in today's market environment, key things that investors should watch in the markets today, as well as thoughts on how one should position their portfolios amidst this backdrop. Let me first turn it over to our speakers to introduce themselves and their respective firms. Disclaimers. Okay, Dr. Emmanuel, over to you.
Good evening, and thanks very much for having me. I'm delighted to be here in Singapore now that the world is reopening again a little bit. So let me talk a little bit about PIMCO, and then I'll talk about myself and our investment process also. PIMCO is a global investment management firm. We have about $2 trillion under management, about over 200 portfolio managers. And while we're best known for our fixed income expertise, we also have specialists in really all types of asset classes. So that ranges from equities, commodities, real assets, alternatives, and so on. And maybe I'll talk a little bit about how we combine our investment process together on the next slide. I've had a number of different roles across PIMCO over time. So when I first joined about 11 years ago, I was focused on structured credit, mortgage-backed securities, and housing markets. And that was really kind of a bottoms-up role where I was doing especially in-depth analysis on big data on our housing data in the United States, building up home price models and housing forecasts. Over time, that also transitioned into working more on real assets, economic forecasting, which is more of a top-down role. We have a quarterly cyclical and secular forum that we run at PIMCO, where economists get together, discuss the economic outlook and what that means for various asset classes. And in fact, we just published a secular outlook piece on our blog. And so I highly encourage you to check that out and see the long-term view that PIMCO has. And I'll mention a couple of things about that as well. But the top-down view is also shaped by our investment committee, which meets nearly every day. And so we've also had the opportunity, I've had the opportunity to serve on that committee a couple of times as a rotating member and bring some housing and real estate and inflation expertise to that. And so as all of that eventually comes together in the portfolio management group, I now work on the multi-asset and multi-strategy teams. And so I'm a portfolio manager investing in our asset allocation groups, which effectively brings together the expertise from all of our portfolio managers across the firm. And we're effectively aggregators talking to all of our specialists and bringing the best of PIMCO together in that set of investments. So I'll pause here and actually one more comment I want to make on the next slide. An additional source of really good top-down information that we get is our access to world-class specialists on our global advisory board. So that includes central bankers. It also includes policy specialists from the US and foreign policy specialists as well. And I think that gives us a really interesting backdrop to bounce ideas off of and get additional expertise that gets brought into our process. So let me pause here and hand it off to Hani.
Thanks, Dr. Emmanuel. And yes, good evening. Good to be with you all. My name is Hani. I'm based in London and have been with PineBridge for about 10 years now. PineBridge is a global, independent, privately owned asset manager. We manage just under $150 billion of assets, which makes us more of a global mid-sized firm, and that's kind of core to our investment advantages. Is having a global footprint across around 25 different offices around the world, but around 200-ish investment professionals who really know each other really well and have been working together for upwards of 15 to 20 years together running different strategies across fixed income, equities, alternatives, and multi-asset, where I'm the head of strategy and spend a lot of my time interacting across all those specialist teams across PineBridge's platform, and really pulling together the best of those ideas that we find conviction in. And conviction is one of the things I would say differentiates us, because a lot of our peers tend to have much more spread out type of ideas in their portfolios. We tend to have much more of an active, high conviction approach, which is expressed very clearly in our portfolios, and ends up making our portfolios very differentiated and complementary to some of the other managers that you find out there, because we tend to go into pockets of markets that are perhaps less well represented in client portfolios. I think I'll just pause there, Sean.
Thank you, Dr. Emmanuel, and thank you, Hani, for your introductions on the firm and yourselves. Just a couple minutes on Endowus. Endowus is here. We're here to help everyone invest better so they can live easier today and a better tomorrow. We think in the interest of the client first, how we can better partner with them on their investment journey. As a result, some of our clients are our biggest advocates, familiar faces you'll see on the page in front of you. On our team, we were founded 5 years ago by Sam, our chairman and CIO, as well as Greg, our CEO. The team has grown. Individuals from both leading global financial institutions and technology companies have come together, including Morgan Stanley, UBS, McKinsey, Amazon, Grab, and many others. In a nutshell, what Endowus provides is in 3 words. We can summarize this in 3 words: advice, access, and cost. We espouse a strategic passive asset allocation. We take long-term views on allocations, and we take data-driven observations. We don't speculate on the markets. We let science prove itself on investment returns. We provide a holistic solutions for clients' wealth needs, like a private bank and a digital platform. We've done rigorous fund selection to curate funds, a list of best-in-class funds that we bring to all our clients. These are managed by some of the world's leading managers, such as PIMCO and PineBridge. We are also the lowest cost offering out there. We only access the institutional share class of all the funds that we offer, or we take the trailer rebates in terms of if there's a retail share class, and we pass this back to the clients. In this way, our advice is fully aligned, and we are the cheapest in the market. We do not charge sales fees, and there are no transactions fees to trade on Endowus. Endowus is mostly employee-owned for further alignment of interest. We are backed by top global strategic partners, such as UBS, Samsung, SoftBank, and Lightspeed. You'll see them on the page over here. We are a fee-only platform, which means that only clients pay us a fee. We are completely aligned with the client. We access the world's leading fund managers. We are agnostic to which managers we want to bring on board. We just look to bring the best funds on the platform. Case in point is this evening, as we're joined by individuals from PIMCO and PineBridge to share their thoughts on the markets. So with that, I want to spend a couple minutes talking about what's been going on in the markets and where we are year to date. So right now, you'll see, as I mentioned, a couple weeks ago, the stagflation word was on everyone's mind. And lately, you can see, there's been comments by certain pundits in the markets talking about the chance of recession being higher and higher, obviously on the back of the recent rate hikes. There were 50 basis points. Now everyone is talking about 75 basis points or even 1% moves. So this is on the topic on everyone's mind. Year to date, what you'll see in the markets is asset classes have moved pretty significantly. So with that, you'll see almost all asset classes are down. We've just put a couple in here that is of interest. Obviously, Bitcoin has had a pretty rough time, but global equities is down about 20% year to date. And what's interesting as well, and very difficult for a lot of investors, is the bond market is down significantly as well. We have here the Bloomberg Global Aggregate Bond Index, which is representative of all the investment grade bonds of the largest bond index in the world. This is down 10% as well. The only asset class on a sector basis that is up is commodities, and that's up 31%. If If I look at a sector kind of dispersion chart, this is again a year-to-date performance chart. What we'll see is at the top there, energy is the top performing sector. It's up about 20% year to date. But what you'll notice is that's not without volatility. At the right side of the chart, you can see there a recent sharp correction on the energy sector. And all the other asset classes you'll see there with their 10 gig sectors in the overall market, all of them are down between 7% and 30%. So all the other sectors are down. And in fact, the darling of the last 2 years, the information technology sector, which was up significantly in the last 2 years, is down the most significantly today. And there are many reasons for this. And then in terms of this chart charts the stock and bond returns year on year. So for every calendar year, what you'll see is performance of stocks. So when stocks are doing well, they'll be up at the top. And when stocks and bonds are doing well, you'll see the top right quadrant. So this happens actually most years. So what you're seeing this year is actually pretty rare in that both equities and bonds have extremely high correlation and they're down. So this is obviously weighing on investors' minds, and it's very challenging for a lot of the long-only portfolios. Finally, kind of on yield curves. So what I have here are two chart plots. So one is the shape of the yield curve that a lot of people are looking at. And the bottom line in blue talks about the yield curve at the end of last year. So this is an upward slope yield curve, wherein the longer dated treasury bonds are yielding higher than the shorter dated treasury bonds, i.e. this implies, generally speaking, a pretty strong kind of growth backdrop for the markets. What we're noticing this year is there's been a lot of flattening. And in fact, on the long end of the curve, there's been a bit of an inversion. And inversions, typically the market thinks of these as warning signals for some rougher roads ahead or growth that is slowing down. Final chart that's interesting as well is obviously the consumer price index, which is a good measure of inflation. So this, you can see there, it was running at a pretty steady pace of about 2+% for the last couple of years. And towards the tail end of 2021 and 2022, as we know, this has spiked up significantly. So what you'll see here is standard deviation lines, and this has moved up 3 standard deviations to the highs not seen in the last 30 years. So the last print was 8.3 or 8.6%. It's extremely, extremely high. And this is what markets are spooked about at the moment. And with that, I'd like to turn it over to our speakers in terms of their key market observations. What are you guys seeing in the markets today? I'll start with Hani. What are your thoughts on the markets and what are you guys looking at?
Sure, thanks, John. So I'll start by saying in our investment process, we have 2 distinct steps that we take. We start with a 5-year type of view, thinking about business cycle ahead and what kind of regime we'll be in to set our fundamental forecasts across different asset classes. That's step 1. And then step 2, we then zoom into the next 9 to 18 month sort of time frame, looking at what the cyclical picture looks like and what the trajectory of the fundamentals looks like across different asset classes. So here I'll just speak to the first step, anchoring ourselves in what kind of a regime and what kind of a cycle ahead are we going to experience. And the thing that we really focus on is how are things going to be different, because every cycle is going to have its own characteristics, and that's really what the market is going to gravitate towards, and our job is to figure that out on a forward-looking basis. And that contrasts with a lot of approaches out there that are much more backward-looking and just kind of assume we're going to mean revert back to some historical average. And we really don't find that to be a very effective way to look at things. When we think about the cycle we're in now, because of the pandemic and all of the things that happened post-pandemic, we're setting ourselves up for a very different cycle. The previous cycle was one where we had exceptionally low growth, low inflation for a very long period of time. And growth itself was very fragile because governments were doing austerity and monetary policy was really the only game in town. It left the entire global economy very weak and vulnerable as we were repairing a lot of balance sheets that had become over leveraged prior to the global financial crisis. What you see on this chart is that government spending was actually in austerity mode for many years, actually a drag on growth, and contributing to a very fragile backdrop. And now, when we look at the cycle we're in here, that's a very big difference. It's that we no longer think that the market is fragile. So the economies are not fragile the way that they were before for a number of reasons. We don't think governments are going to retrench back into austerity and trying to fight the debt problems through austerity. There's no appetite to do that, and lessons have been learned. And so we don't think that's going to repeat itself, which means that you won't have that drag at least. It may not be a massive positive driver, but it will be removing a drag, and that's a significant aspect of why growth will be more stable going forward. On the next chart, you'll see that the private sector is also in a very different position. The level of debt that the consumer had post the global financial crisis of 2008 was very extended, and households began to deleverage their balance sheets. And that's a very painful process for growth. It just means people are postponing consumption and investment and are paying down debt. This time around, we're in a very different starting point. Household balance sheets are very strong, the levels of debt's much lower, and that means that we don't have this repair process to go through. So the private sector looks pretty solid as well. And the third thing is that in the next slide, you'll see that unlike the GFC, this time around, we got a huge policy response, both from the monetary side and the fiscal side, that accelerated the recovery much faster than the last cycle. So what you see on this chart are unemployment rates. It took us more than a decade to bring unemployment down from double digits down to about 3 or 4%. This time around, we've got back within 2 years. Now, we're dealing with the opposite problem now, which is the inflation. We overdid it, but this is clearly a very different starting point compared to the last cycle, where it took us a long time to recover. And that's why inflation was very low last time around. And that's why it's not going to be the same this time, because if you go to the next slide, you'll see whenever we get down to these kind of low levels of unemployment, that's when you start to see wage growth start to firm up, and that flows through into inflation. And so one of the key characteristics we think you'll see in the cycle ahead is a much firmer level of inflation than we had in the last cycle. We don't think that we're going to stay at these current levels of crazy inflation, but we're going to gravitate lower towards a more firm level of inflation compared to where we were, for all these reasons that I've laid out. So maybe I'll pause there and hand back to you, Sean.
Thank you, Hani, for your comments. And maybe turning to Dr. Emmanuel, any additional comments to add? What are some of the drivers behind these high inflation prints? Should investors be concerned?
Sure. So as you mentioned, probably the key and primary drivers of financial markets at this point in time really is the inflation outlook and the corresponding actions that central banks need to take in order to bring inflation back down. So as Hani noted, we've gone through a couple of cyclical adjustments over the course of the pandemic. We deployed enormous fiscal resources in order to send money to consumers and to businesses in order to help them to survive the pandemic. But following the pandemic now, this is actually turning into somewhat of a fiscal drag, because all of that is going away. Consumers do have some excess savings that they accumulated, but those are already being spent down. Another element that occurred during the pandemic was a major change in the type of demand and the way that demand was deployed by consumers. So people needed more goods, people needed more housing, people needed housing in different locations in order to be able to work from home. And so all of that is again changing as the economy reopens and consumer demand tilts back potentially towards services. And I think the big issue and another big issue that is that at the same time as this demand shift was happening, the supply picture really changed, because we had effectively locked down production for some time. We locked down shipping and logistics lines, and so supply chains were effectively non-functional for a while, and now all of that is again reverting. And in fact, we're facing almost the opposite problem, where orders that were placed a year ago are now finally arriving on store shelves at a time when people's demand is shifting back towards services. So there's this misalignment between what's available in markets for people to consume, what consumers need at any given point in time. And so all of that is creating frictions in the economy and reducing its efficiency. And so that's one of the drivers of inflation that we're seeing at the moment. And so at the time in March and during our previous cyclical forum, we called this an anti-Goldilocks environment, an environment where we have higher inflation and potentially lower growth. And this elevated inflation picture is really forcing the Fed and central banks to react very harshly. They really want to see inflation come down persistently into the 2% range, and they might tolerate inflation a little bit higher than that. But they definitely do not want it to get out of control and get a repeat of the 60s and 70s. And if you turn to the next slide, you'll see kind of the history of inflation as it occurred over time. The 60s and 70s were a period of persistent inflation during which monetary policy allowed inflation to get really out of control. And that had severe economic consequences. And so the Fed is going to be very focused on stopping that. And so that means that aggressive policy actions are going to continue for some time. That's going to slow growth naturally. And slower growth, I think, leads to greater economic fragility. And if we run our business cycle trackers, we do see that the business cycle is really in the later phases of the economic expansion. That doesn't necessarily mean that a recession is right around the corner. And we've had late cycle expansions that were extended through fiscal support or additional monetary stimulus over time. We saw that, for example, in 2015, 2016, where in 2016, there was a wave of fiscal stimulus. In 2018, 2019, there was a monetary easing that would have allowed the expansion to continue were it not have been for COVID. But in this environment, at least cyclically, we probably cannot count on fiscal. There's gridlock in Washington, and there's a certain limit to how much fiscal can be deployed in Europe for the time being. So I do think there is potentially greater fragility, and this leads us to some major asset allocation implications, which I think I can talk about later.
Thank you, Dr. Emmanuel. Thank you, Hani, for your comments. I think just touching on a little bit more kind of on, Emmanuel, your points, right? There's more fragility in the market, there's slower growth as well, and then there's less kind of fiscal dry powder that can be kind of looked at going forward. So, kind of question on investors' minds is essentially on the screen, right? Is what's the likelihood? What are some things that investors need to look out for to kind of gauge the probability of a recession in the next 12 months? Or, when are you guys seeing this? What are some of the levers over here?
Right. So as I mentioned, if we are in a late cycle environment, right, then that leads to some greater economic fragility and potentially greater risks of a recession. And I think the real potential drivers of a recession is what is going to happen with inflation and what central banks have to do in order to bring CPI back down. So we do think inflation is going to naturally start coming down over time, because of the fact that as consumers have shifted their demand back towards services, we have excess inventories, and that's going to be a drag on inflation. We do think that auto manufacturing is already coming back, and so automobiles had been a really big driver of inflation over time as well. But the bigger challenges on the services side of inflation, in particular, shelter and rent prices are much stickier than many other elements of the consumer price basket. And so as a result of that, as inflation continues to accelerate over time, and in particular, unemployment remains low, and housing affordability is challenged, and mortgage rates become higher, that also feeds into the prices of rent. So inflation is has this very sticky element that doesn't allow it to come down quickly enough. And if the Fed and central banks are really following that piece of data, they might not necessarily see inflation come down in a persistent manner as quickly as they would like. And that's been really exacerbated recently by geopolitical factors. So that includes the war in Ukraine, which has limited food exports to the world. There's additional food-related issues just that are purely weather-related that have nothing to do with Ukraine. But in addition to that, there's also the feed-through effects from higher energy prices. So, for example, airfares are effectively a direct pass-through of oil prices into a component of the core inflation basket, which the Fed looks at. And so that's only in the US, but in Europe, the situation is even tougher, right? Europe is much more directly exposed to Ukrainian energy, to Russian energy costs. And so we've seen European energy prices increase at an even more rapid pace than in the US. Europe especially is challenged because as interest rates rise, it becomes more difficult for peripheral countries such as Italy and Spain to maintain their debt sustainability. And so that places the ECB in a very challenging position. So in terms of what that means for recession probabilities, if we look at our recession probability trackers, we see probably a low probability of recession over the course of the remaining year still, simply because we are in this relatively healthy initial environment. But there is greater economic risk two or so years out. And I think you can even see that in financial markets. You showed the yield curve earlier. And so the yield curve currently, like a 3-month, 10-year spread is positive. But if you go about 6 months out, right, the 6-month forward, 3-month, 10-year, which is kind of a mouthful, that starts to invert. And so you start seeing some greater recession risk effectively being priced into markets there as well. So maybe I'll pause here. I'm not sure if I have any other slides to cover in this section. Actually, one more. Yeah, you're right. One more thing I wanted to cover is in this higher inflation environment, right? The stock bond correlation has increased, and so you can, if you look at the historical data, right, that we've seen that a couple of times in the past, but the most notable period when that occurred was during the 60s and 70s, and the 60s and 70s were a period of great economic fragility as well. We saw multiple short recessions, many downturns in the economy that were effectively alleviated. And one of the challenges during that period was also that the Fed and others were not really coming to the rescue of the economy at any given point in time. And recessions were needed in order to cool down inflation temporarily and bring the unemployment rate up. So there is sort of the concern that we might be returning into an environment like that.
Thank you, Dr. Emanuel, very, very clear on your comments. And maybe turning over to Hani. So obviously, you alluded to this earlier, the markets have gone through a significant period of quantitative easing of late, particularly on the back of the exogenous shock that was the COVID-driven kind of sell-off. And obviously, central banks really came in, lowered interest rates and put on a lot of easing. And we're going through kind of right now, how do investors think about the road forward, right? Everyone's talking about quantitative tightening, and then how does that end?
Sure, yeah. So, I mean, this is our biggest worry, to be honest, for the markets. It's less of an issue for the economy itself. I think there's very mixed evidence about how much has QE actually supported growth in the economy. But there's no doubt that it has been a massive support to financial assets over the decade plus that we've been through. This chart kind of just illustrates that. It's a very high correlation. And the next slide does as well, just saying that, look, we've been in an environment where monetary policy was acting directly through financial conditions and supportive, exceptionally supportive of financial assets through its QE program, as well as on the rate side. And because where we are now is not fragile, it's actually, we're too strong right now, especially if you look at the US. The problem is strength. The problem is excess strength that they need to undo. They have to fight this strength. That's the problem we have, not weakness or fragility. It's actually excess strength. This all has to go into reverse now, and that's what QT is about. And that's just going to be a very steady headwind for markets. Maybe not so much for the economy. We're less worried about the economy per se. Even if we have a recession, we think the shortage of labor, the tightness of labor markets means that there's a decent chance that it's not going to be a very severe recession or a crisis of any kind. We may end up with shallower recessions as we deal with, but the core of the problem is actually overheating because of excess strength rather than the other way around. And that's the way we think about regimes. If you see the next slide that I have, it's a very busy one. I'm not going to talk in detail about it, but this is some of our regime framework where we think about this sort of level of strength of demand versus supply, both in the real economy and in the financial economy in terms of liquidity. And where we are now is really the bottom right of this diagram, where we're essentially overheating, which means we have excess demand in both the real economy and in financial assets, and that needs to be undone. The interesting thing is that this is the opposite of where we were pre-pandemic. We were in what we call a stall speed environment where growth was weak, and so there's an excess of supply rather than an excess of demand. There was a demand deficiency for a very long time because of extended balance sheets and fiscal austerity and so on. And that's why you had this kind of negative correlation between equities and bonds, and you had protection coming from fixed income. That's when we were in stall speed. You have the opposite when you're in the overheating regime. And the question is, where do we go from here? I mean, we think that overheating is a temporary phase that we'll be in, and we're going to sort of move more towards a balanced growth type of environment. But where I definitely agree with Dr. Emmanuel is that if we think that you're going to have shorter cycles that will need to be reset through more frequent recessions, perhaps. In that sense, you could say that the system is a bit more fragile, but it's actually due to tightness, which at its core is actually due to strength rather than weakness. And I think that's where we're going to be for some time to come. And that's a much more challenging investment environment. You need to be a bit more creative in what kind of markets or strategies that you go into to deal with a very different backdrop than where we've been and where we maybe got very used to making easy money for a long time. I think those days are over.
Thank you, Hani, for those comments. Maybe I'll stick with you just for a little bit longer. Kind of, obviously with recession on top of people's minds, there's a lot of kind of questions coming in around this as well. Thank you, audience, for your questions. What are, do investors stay away, or should they invest in the markets? And what are some of the strategies or investments and investors should consider at this stage? What performs well during the current market backdrop? And then what do you expect will continue as the regime changes? What do you think will continue to perform over this cycle? And obviously a shorter cycle as well on that.
Yeah, sure. And actually, Sean, maybe you can skip to the next slide first, and then we'll come back to this one. Yeah, so this is our capital market line. This is the anchor of our investment process, where we look out the next 5 years and forecast what we think the underlying fundamentals are going to do. Our process is very fundamentally driven. And then we basically translate that into forward-looking expected risk and return. So what you see on the chart here are 5-year annualized forward-looking expected returns and risk. It's quite a mouthful, but just to give an idea of what this is, we think this is what things will average out over the next 5 years, rather than a single year type of view. And overall, it still indicates that equities are generally speaking going to be a better place to be positioned to achieve better risk-adjusted returns and better real returns compared to most of fixed income. That's over the next few years. But if I think about the here and now, over the next 9 to 18 months, we've been very bearish coming into this year. We've been positioned very bearish this year. And it's because of this overheating environment, which is difficult for both equities and bonds. So our advice to clients has been to minimize your exposure to both. Now, those tend to be core asset classes in most people's portfolios. So that's a challenge. What do you do then? What else do you buy? Well, we think you have to be really creative in terms of looking at alternative ideas away from those core markets. And one example that I showed is on the prior slide, Sean, and that is trend following strategies, which fall effectively under hedge funds or alternatives. And these are sort of technically driven strategies that follow trends, and they can be following them both on the long side, benefiting from prices going up, and on the short side, benefiting from prices going down. They are agnostic about that, and they just follow the trends. And what you find is that these type of strategies perform well when you have higher and more volatile levels of inflation, driven by big macro trends, which is what we're seeing, in the markets today. And you'll see that these strategies have done extremely well year to date, and they actually act as a downside protector. So this is something like an alternative to fixed income, because it can actually give you some downside protection at a time when bonds are not giving you downside protection. So that's one example of something that you can consider to add to your portfolio if you have access to that. We recommend things like that you get some, the function of bonds without owning bonds, meaning that they give you protection without actually being exposed to interest rates. These are the type of strategies that we recommend for this environment.
Thank you, Hani. Very clear. So still constructive on equities, but maybe not at the current moment. And then obviously, if you can buy some trend following strategies, by the way, these have done actually very well this year. And so, investors should look into that as well. And maybe switching over gears to Dr. Emmanuel, earlier you mentioned kind of the stock and bond correlation being very high at the moment. What do you think, will that turn over as markets kind of normalize? I don't know if that's the right word. Does diversification work? What specific asset classes is your team looking at today?
Sure. So let me answer maybe first the question about stock bond correlation. So you can see on this slide that stock bond correlation became negative during periods of lower inflation, and it became positive during periods of high inflation back in the 60s and 70s. But I do want to point out that even during the 60s and 70s, when a recession occurred, during that period of the recession, the stock bond correlation became negative for that period. So in particular, that means that during recessions, even during high inflation environments, bonds actually did protect multi-asset portfolios. It was during the expansion environments and during those longer term expansions that occurred during that period that bonds and stocks, in many cases, either both went up or both went down. But during recessions, the multi-asset portfolio functioned well. There are a couple of other things that investors can do in this type of environment. And one of the questions we get sometimes is, if there is a recession risk, then how do you position yourself, right? You don't necessarily know how to time the recession perfectly. And there's a couple of things we do. One is investing in style factors and identifying factors that perform well both during the late cycle and during the beginning of the recession. And I was actually very relieved to see on Hani's slide that the US quality factor is pretty much on the top left of his chart. And the reason he has that there correctly is because high quality equities are some of the highest performing are some of the highest performing types of names during both the late cycle environment and also during the beginning of a recession. So you don't need to time the recession perfectly if you are invested in equities that have high ROEs, high ROAs, strong balance sheets, strong cash flow generating capabilities, and so on. And there are different ways of getting exposure to that, either through long short quant strategies or simply by selecting the appropriate names in a long only portfolio. In terms of fixed income, I do think that if you're worried about a recession occurring, then having some allocation to fixed income is important. As I mentioned, the stock bond correlation does become negative during those periods of time. And another benefit to fixed income at the moment is that as cash rates have increased, the yields on fixed income have gotten to levels that we haven't seen for a very long time. And so that means that core bonds yield over 3% now. That means that investment grade bonds are even better. But it also means that if you want a high quality fixed income portfolio or a higher yielding fixed income portfolio, you don't necessarily have to reach for yield and go into distressed credit or high yield or emerging markets or things like that could potentially be hurt in a recessionary environment. You can actually stick with high quality fixed income, strong balance sheet investment grade companies, debt, or even core bonds or agency MBS that will protect you in the event of a downdraft. And then, of course, the other concern that we get from time to time is how to hedge inflation. And I think the main thing that often comes to mind is TIPS and inflation protected securities. And people ask themselves why it hasn't worked in this environment all that well, right? And the reason for that is because TIPS give you exposure to long-term inflation expectations in many cases, so 10-year break-evens plus. And if you switch to the next slide, there's actually a broader menu of inflation hedging asset classes that investors can choose from. So that does not only include TIPS or inflation-linked bonds, it includes emerging market currencies that often have inflation-related beta, commodities, of course, gold, but also global real estate, which has a certain amount of equity exposure, but it does have some real asset exposure as well. And so the question then is, how do you allocate to those? And by the way, as you can see on the right side of the chart, bonds and equities have negative inflation beta or negative exposure to inflation. So one can allocate across some or all of those at any given point in time, but they perform differently in different regimes. So maybe turn to the next slide. And actually, one additional point here is that these have different risk levels as well, right? So you don't want to have like an all commodities portfolio in order to hedge your inflation, and you might not necessarily want to have an all TIPS portfolio. And on the next slide, you can see which regimes they perform really well in. So TIPS and gold, right? They perform well in a low growth, high inflation environment, right? We're currently still in a sort of higher growth and high inflation environment, which is why commodities, which usually outperform in a late cycle environment, have been outperforming at this point in time. If we move into a stagflationary environment, right, TIPS and gold are more likely to outperform. During a previous higher growth environment, we saw equities and real estate perform best. And so if you have a certain amount of uncertainty about which of these quadrants the world is going to end up in, allocating across some or all of them gives you inflation protection, no matter which of these outcomes gets realized. Maybe the next slide then. What we like to do is, as I mentioned, allocate across all of them. And maybe the easiest way to do that is by simply allocating an equal amount of risk to all of them. They have different levels of volatility. And so if you just inverse vol scale it and allocate the same amount of risk to each of these asset classes, you get a larger allocation to TIPS, simply in terms of percentage value. But because they're less volatile in general, that gives you the same amount of risk as a 10% allocation to global real estate or to gold or to commodities. A similar way of doing that is by looking at the inflation betas and allocating a proportion to the inflation beta, which also gives you a similar type of allocation. So there are portfolios like that investors can construct in order to have a certain amount of inflation protection across the cycle.
Thank you, Dr. Emanuel. Thank you, Hani, for your comments. So I hear you, definitely negative correlation to equities on fixed income, and yields have definitely moved up across all fixed income asset classes. That is certainly very attractive, I think, on the back of kind of the rate rises as well. And maintaining diversification is very important across clients' portfolios. We had a question kind of come in, and I'd love to hear your take on this, and Hani as well, on kind of inflation, right? And we spent a lot of time talking about it. Do you think it's transitory? Is it higher for longer? And how does that tie in with cycles being shorter? Do investors have to be more nimble in their asset allocation? Should they think of how should they think about kind of moving across kind of the different parts of the cycle? And obviously, there was very positive feedback on kind of that capital market line and the asset classes as well. So maybe I'll start with Dr. Emmanuel and then Hani.
Sure. So in terms of allocating across the cycle, so typically during the early phase of the cycle, it's a great environment for risk. You want to be exposed to equities. Later in the cycle, inflation starts to often increase, and so commodities tend to outperform. And as a recession starts to arise, that gives you that often gives you better performance for bonds. And so you're right that during a higher inflation environment, the economy becomes somewhat more fragile. The cycles often get shorter, and this cycle is maybe a key example of that, right? So the reason we haven't seen really good performance for equities during the late part of the cycle is because the hiking cycle has happened so quickly compared to other cycles in the past. Typically, Fed hikes tend to compress the equity earnings multiple. And so we started from a very high multiple of around like 22 times earnings. And with all the hikes that we've seen, we're now at like 16 and a half, 17 times earnings or thereabouts. And so I think that corresponds to the typical multiple compression that you get over the course of a Fed hiking cycle. So it's not that equities have necessarily priced in a risk of recession or anything like that. They've basically accurately priced in the higher inflation environment that we're seeing at this point in time, the correspondingly more aggressive central bank policy action that we're going to see as a result of that. But to your point about where inflation is going to go from here, central banks have really determined that they want to keep inflation under control and get it back under control. And so until they see inflation really start to come down on a persistent basis, they're going to remain quite aggressive, even if that means producing some significant economic slowdown from here on out. That means that, I don't know if you'd call it transitory, but I think persistently high inflation along the lines of what we saw in the 60s and 70s should not be our base case. Doesn't mean that you shouldn't have some exposure in your portfolio protecting you against being wrong, but it shouldn't necessarily be the base case.
Thank you. And Hani is just wondering if there's anything you want to add on those points.
Yeah, I'll just say that, look, what happens with inflation from here is really very difficult to say. I don't think anybody can answer that question, to be honest. I don't think anyone really knows how it's going to actually play out. And what I mean by that is that at this point, it's not just about, is it peaking or not? Is it going to come down or not? You really need to know how fast it's going to come down, if it is going to come down, because if it stays elevated for a long time or it comes down very slowly, then we're in much bigger trouble. The central banks will push even harder, and it raises that risk that we just have to. The only way to stamp it out is through a painful recession. That's one particular scenario. There's an in-between scenario where, look, it starts to go down, but it's it's a moderate pace, and yes, they tighten, but maybe there's a way to get away with, let's say, a moderate recession, or maybe even a softish landing, if I use Powell's words. And then there could be a miracle where the inflation just fades very quickly. And we go back to a very low inflation environment, and then things would be super bullish across the board. So I think at least having these different types of scenarios in mind, how does it actually play out? We'll have to see, but at least having these types of scenarios is helpful to think about what could happen. But probabilities are very difficult to assess in terms of which one we're going to end up with. I think the third one is the lowest probability, but how quickly is inflation going to come down, and how hard are central banks going to have to push is more something that you need to see and adapt to, rather than trying to really predict it with any kind of confidence. Because personally, I don't think anybody can really do that.
Okay, thank you. Thank you both for your comments. Just being mindful of the time, just gonna take a quick look and see if there are any further questions from the audience that we'd like to answer at this time. Okay, if not, I think we can mostly end the session there. I will just do a quick shout out to kind of thank you very much, Dr. Emmanuel from PIMCO and Hani from PineBridge for taking the time for the insightful dialogue as well and all the commentary that you provided. Maybe in kind of closing comments, just kind of a slide on if you want to find out more and experience Endowus, please scan the QR code here. A team of licensed financial advisors are ready to speak with you at any time. And again, use the Endowus platform to get access to top tier managers that manage strategies that are run by teams that Dr. Emmanuel and Hani do run as well. Very exciting times and very challenging times for the markets. And obviously, thank you all for your time and have a good evening.
Thank you.